To comfortably cover living expenses after Social Security, the standard benchmark for a middle-class retirement is $60,000 in annual passive income. If you build a conservative dividend portfolio generating a 3.5% yield, hitting that target requires a $1.7 million stockpile of capital. There is an aggressive alternative. If you buy assets paying out a 13% yield, that same $60,000 income stream costs just $462,000. This shortcut shaves well over $1 million off the savings goal. On paper, it seems like the obvious choice for any investor looking to retire early. However, the long-term math reveals a deeper problem. These high-yield payouts often trigger a process of capital erosion that can dismantle a retirement plan from the inside out. The stock market features an aggressive tier of dividend-paying assets, where current yields routinely hover between 8 and 14%. Payouts this high rarely signal a thriving business. They typically mask severe corporate distress or a dangerous reliance on leverage to keep the cash flowing. To maintain the illusion of a double-digit payout, these companies are often forced to cannibalize their own book value, steadily destroying their equity to fund the dividend. Investors in this tier are effectively funding their own payouts through the slow liquidation of their own principal. They are spending the asset itself while waiting for an inevitable dividend cut. The alternative is the conservative tier. These are Dividend Aristocrats, companies that offer lower starting yields but have increased their payouts every year for decades. We can see the result of this strategy by looking at Warren Buffett. In 1994, his company, Berkshire Hathaway, completed a $1.3 billion acquisition of Coca-Cola shares. If you look at Coca-Cola today, the current dividend yield sits at a seemingly modest 3%. But that figure ignores a metric called yield on cost. This measures your annual cash income relative strictly to the original price you paid for the investment. Over the last 3 decades, Coca-Cola grew its cash dividend by 268%. Because of those annual hikes, Buffett's yield on cost on his original 1994 shares is now 63% per year. For long-term wealth preservation, the starting yield of an asset is less significant than the trajectory of its dividend growth. To see this in action, we can track a 15-year race between two $600,000 portfolios. Portfolio A relies on a stagnant 10% yield, while Portfolio B starts at 3.5%, but grows its payout by 8% annually. In year 1, Portfolio A dominates. It generates $60,000 in cash, while Portfolio B produces just $21,000. By year 10, the gap narrows. Portfolio A's payout hasn't moved, but Portfolio B's 8% annual growth has doubled its cash flow to $42,000. This leads to the crossover point, the exact moment the growing income stream from the conservative portfolio permanently eclipses the stagnant high-yield payout. Over 15 years, the growth portfolio generates $200,000 more in cumulative income. It also experiences massive principal appreciation, while the high-yield portfolio's value often decays. The math of compounding ensures that a growing income stream will eventually overtake and surpass a stagnant high-yield payout. This advantage is most visible during the accumulation phase, the years when an investor can afford to reinvest their dividends rather than spending them. By using dividend checks to automatically buy more shares, you create a loop where those new shares produce their own growing dividends. Because these companies raise their payouts annually, the reinvestment cycle acts as a shield against inflation, helping a portfolio's purchasing power outpace the rising cost of living. The strategy builds a dividend fortress, a portfolio of disciplined corporations that have generated higher returns with lower volatility than the broader market for decades. Financial independence relies on an income stream that is structured to provide a raise every single year. By focusing on growth over starting yield, investors can protect their principal and their future.